Hey, I'm Jonathan Wild, and we are going to cover how to record the issuance of common stock. Issuing common stock is all about selling ownership in a corporation. This can be an exciting time as selling common stock comes with new investors and increased capital to expand the business. Also, if you are really successful, this can be your opportunity to sell all or part of your corporation and become super rich. The accounting depends on what type of common stock you are issuing and at what price. In our first example, we will issue common stock at par value, which establishes minimum legal capital. But we won't worry about those details for now. So let's do an example. Assume we issue 10,000 shares of $1 par value stock for $10,000 cash. To record this entry, we debit cash for $10,000 and credit common stock for $10,000. This entry increases both an asset, cash, and an equity account, common stock. Let's do another example. Assume we issue 10,000 shares of $1 par value stock for $9 per share, or $90,000 cash. In this case, we are selling the stock for $8 per share, more than the par value, which is called a premium on stock. To record the entry, we debit cash for $90,000, credit common stock for $10,000, and credit paid in capital in excess of par value common stock for $80,000. This $80,000 is calculated as the $8 per share premium above the par value, multiplied by 10,000 shares. Paid in capital in excess of par value is an equity account and is reported on the balance sheet of a corporation. Let's do another example. Assume we issue 10,000 shares of no par common stock for $13 per share for $130,000 cash. In this entry, we debit cash for $130,000 and credit common stock, no par value, for $130,000. Next, let's issue stated value stock, which is similar to par value stock in that it establishes a minimum legal capital. But again, let's not worry about that here and instead focus on the accounting. So assume we issue 10,000 shares of common stock with a stated value of $2 per share in return for $17 cash per share. In this case, we debit cash for $170,000, which is the $17 per share multiplied by 10,000 shares. We credit common stock for $20,000, which is the $2 per share stated value multiplied by 10,000 shares. And credit paid in capital in excess of stated value for $150,000. This is computed as the $170,000 cash received minus the $20,000 stated value of the shares. Like par value stock, any amount above the stated value is credited to paid in capital in excess of stated value. This equity account is reported on a corporation's balance sheet. Now, what if we issue common stock for assets other than cash? Let's say we are expanding our business and we need some equipment. We can't afford to pay cash, so we offer the seller stock in our corporation instead. In our example, the equipment is valued at $60,000, and we exchange this with the seller for 5,000 shares of our $1 par value common stock. To record this, we debit equipment for $60,000 and credit common stock for $5,000, which is the $1 par value multiplied by 5,000 shares. Next, we credit paid in capital in excess of par value for $55,000. This is the $60,000 value of the equipment minus the $5,000 par value of the shares. It is also normal to give people shares in exchange for their help in setting up the corporation or facilitating the sale of the stock. As an example, assume we issue 2,000 shares of $1 par value common stock for $38,000 worth of organizing work. In this case, we debit organization expenses for $38,000 to recognize the expense of this work. We credit common stock for $2,000, which is 2,000 shares issued multiplied by $1 par value. Then we credit paid-in capital in excess of par value for $36,000, which is the $38,000 organization expense minus the $2,000 par value of the shares.